last video, we spoke about the BEPS project, the base erosion and profit shifting project of the OECD, and its major impact that it has had on international tax structures. BEPS was only Pillar 1. The OECD also has started a second project, which is referred to as Pillar 2. And where Pillar 1 looked at all sorts of individual rules in countries and the mismatches between those rules, Pillar 2 is a very broad shot. It basically introduces a minimum tax of 15% across the board. So a multinational company, wherever it's doing business, it should pay on average at least 15% of tax. I think it's a good thing. It stops the race to the bottom. It's certainly in the interest of the OECD countries. You can ask whether it's also in the interest of smaller developing nations, because for them their corporate income tax revenues really isn't that important. For them it's much more important to gain experience and know-how and bring foreign businesses to their shores. Whether they pay tax or not is not so relevant, and if they pay tax, well, those could be all sorts of taxes. That could be a sales tax, a value-added tax, a wage tax, mining rights, what have you. Corporate income tax is just one of them. But certainly for the OECD countries, there has been a debate about the race to the bottom, and the Pillar 2 proposal should be able to stop that, and will stop that. I'm quite convinced about that. It's important to recognize that what made BEPS so successful, so Pillar 1 so successful, was the fact that the EU completely embraced the BEPS proposals, and they actually introduced two directives, the Anti-Tax Avoidance Directive number 1 and number 2, that were adopted by the EU and then had to be implemented by the member countries mandatorily, no escape. You have to implement those rules that were European rules, but they were exact copies of the BEPS rules. And now the same has happened with Pillar 2. At the beginning of the BEPS introduction, most companies and advisors thought, well, okay, this is the OECD, let's see what happens. And we didn't think it was going to be that successful. But now we've learned our lesson, and I think everybody is very much aware of the fact that since the EU again has now drafted a European directive that has been adopted already and has to be implemented now, basically the Netherlands has already introduced the new law that will enter into force January 1, 2024. So that's only a few months from now. And all of Europe will need to introduce those rules. This 15% tax, to whom does it apply? It only applies to multinational groups with a turnover of 750 million euros. If you're under that threshold, you don't have to worry about it. It simply does not apply to you. It's a calculation of an effective tax rate per jurisdiction. So not per entity, it's per jurisdiction. So if you have a number of subsidiaries in the Netherlands, we group them all together and we then calculate what is the effective tax rate. Are you above or below the 15%? It's not based on your tax filing, it's based on your financial statements. IFRS, whatever GAAP you're using, and then we calculate the effective tax rate. As of 2024, 2023 is a transition year. There are a couple of safe harbor rules, there are a couple of anti-abuse rules that I won't go into, but to give you an example of, in good OECD fashion, of course, they're completely overshooting their goal, because if in 23, for instance, you're transferring an intangible from company A to company B in the same country, and company A is paying tax on the capital gain, company B is, however, forced to continue, for purposes of this calculation, with the old book value of company A. Which doesn't make any sense, because company A already paid tax on that gain, so company B should have been allowed to base its calculation on that higher basis, the acquisition price that it paid to company A. I'm quite sure that this will be corrected, but so far it's actually quite an annoying problem. Now, How does this work, this 15% tax? Imagine that you're below that threshold. Then first of all, at least in the Netherlands, not all countries have adopted this, there's a QDMTT, the qualifying domestic minimum top-up tax. So basically, if the Netherlands realizes that you're only at 13%, then the Netherlands tax authorities will levy an additional 2% to bring you to that 15% tax. If we wouldn't do so, then the parent company or an intermediate parent company could do so under the IIR rule, the inclusion rule that's typically applied by the parent company. Otherwise, there's also a group rule, for instance, if the parent company is not paying the 15% tax, and that is the under-taxed profits rule. It's a whole set of new rules. I won't go into all the details. We're also getting familiar with it ourselves at this moment. There's a new instruction. If you're subject to IFRS, then the International Accounting Standards Board has issued recently IAS 12 on income taxes that you should definitely consult in when implementing this in your own systems. Should you have any questions, please do reach out to us. Thanks very much.